So here I am again. This time we're going to introduce, alongside monetary policy, market indicators. What are the indicators saying out there? Then economic statistics, particularly those for April, because everything changed with the bank crisis. And then finally, a few thoughts on artificial intelligence and electric vehicles in the innovation space at the end. Okay, fiscal policy. So this week, Janet Yellen, Treasury Secretary, came out and said that she thinks that the government will run out of money to pay bills by June. And so many people thought it would last through August, but apparently tax revenues are not coming in as high as they thought. And so the deadline is now moved from what many people thought could be August, September to June 1st. So this is all about the debt ceiling debate. And we know there is a big divide between the president's proposed budget and what the House is coming up with, and they do not seem to be talking to one another. We know they're going to raise the debt ceiling. I think they've raised it every year except 2, and the political stakes are pretty high. We are entering into an election year, so we think they'll figure it out. I don't know if there will be a technical default or not, but they're going to figure it out. The debt ceiling will increase, and the question is, will they come up with a budget at any point in the near future? The one thing I wanted to focus on in terms of fiscal policy and all of the government spending that has been spewing out since the beginning of COVID is that it seems like government spending is beginning to crowd out the private sector. And what I mean by that, this is related to the banking crisis, actually. If you look at what people are doing with their money as they leave banks, they're going into Treasury securities for the most part and money market funds. That's not the way the world is supposed to work. You usually increase your returns as you're increasing risk. And this was really a concept that came out of the 70s and early 80s. Henry Kaufman and Al Wojchnauer were the two economists who really focused investors on this thought that, the government was, from a funding point of view, taking away opportunities from the private sector. Why is that? It's going on this time because deposits in a banking system can be turned around into making loans, but funds flowing into money market funds backed by the Treasury securities, the Fed did increase the Fed funds rate again, 25 basis points. We're now at 5.25, 21 times where we were a little more than a year ago. Now, never has the Fed raised rates in the middle of a crisis. Now, I listened to Jay Powell's presentation and his Q&A session, and not once did the concept of money supply come up. So it is interesting to note that M2 is accelerating to the downside. M2 in the month of March was down 4.1% on a year-over-year basis. And we think it'll be down 5% or more in April. Money supply declined at a 14.7% annualized rate. I want to make sure that you understand that concept. We've never seen a swing in money supply like this one. We've gone from 27% increase in February to now minus 4.1%. And one of the things that puzzles us is that the Fed is not talking about money supply. Any one of them has been involved in the financial markets. Neil Kashkari at the Minneapolis Fed was at Goldman for a while and PIMCO for a while. But the way I understood his roles, he was more of a relationship builder. I don't think he was watching market signals. I understand that they probably don't respect market signals the way we in the market think they should respect them, but they should respect economic signals. And if you look at the basic identity that everyone learns in Macroeconomics 101. It is MV equals PQ. It's an identity. They have to equal. PQ is nominal GDP growth. And it was, I believe, 6 to 7% range on a year-over-year basis in the first quarter. So that's nominal GDP growth. On the other side is money. And I just mentioned that in March, money was down 4% on a year-over-year basis. For the quarter, it was probably down closer to 2%. So minus 2% on this side. And how do we do that? It's with velocity. Velocity is the rate at which money it turns over in the markets. So velocity must have increased roughly 9% in the first quarter. And so it's doing what it usually does after a crisis. It's trying to get back to the actual downtrend that's been in place since 1997. And we do not believe it will get back there. The reason is the banking crisis. During a crisis, velocity usually slows down, the rate of increase slows down, flattens out, and actually goes down. During COVID, velocity collapsed. Money growth is unlikely to turn around given what the Fed policy is doing. And I just mentioned it's accelerating to the downside, exacerbated, of course, by deposits leaving the system. Now, I think the Fed has something like 200 PhD economists. And one would think that Macroeconomics 101 might be a consideration in the policy discussions and in the minutes of the Fed meetings and in the speeches that Chairman Powell and others give. We don't hear it at all. But I think market signals are going to force this topic upon the Fed.